In late 2025 and early 2026, one of the world's biggest financial institutions, Bank of America, released a forecast that sent shockwaves through the precious metals world. According to their head of metals research, Michael Widmer, gold is expected to average around $4,538 per ounce in 2026, with potential to reach as high as $5,000 if investor demand continues its current trend. But beyond gold, his analysis highlights silver's explosive upside potential, compared with where it stood just a year earlier. Silver, which hovered around $50 per ounce in late 2025 after a 75% year-over-year rally, is now projected by BofA to climb to $65 per ounce by 2026, a roughly 34% upside from recent levels if market conditions tighten further. The Economic Times +1. What makes this outlook particularly intriguing is the use of the gold-to-silver ratio as a valuation signal. Historically, when this ratio contracted to lows seen in major bull cycles, such as 32-1 in 2011 or as extreme as 14-1 in 1980, silver prices spiked dramatically relative to gold. Based on those historical extremes, Widmer's report suggests silver could theoretically top out between $135 and even $309 per ounce if the ratio fully reverts to those rare lows. That's more than a 200 to 500% move from current prices, a statistical possibility the report does not dismiss, though it emphasizes such peaks would require major shifts in market sentiment and investor positioning. Despite the bullish narrative, BofA and other analysts also note caution. The bank's own forecast acknowledges that while the long-term trajectory points higher, the metal might still experience short-term corrections and volatility, especially if interest rates remain elevated or if physical supply dynamics fluctuate. In fact, HSBC's updated models for 2025 to 2027 see silver averaging $33.96 in 2026, a significantly more conservative estimate than extreme peak scenarios, reinforcing that forecasts are not unanimous and depend heavily on macro variables such as industrial demand, geopolitical pressures, and central bank policy shifts. From an investor's perspective, the backdrop for these forecasts is a market that is structurally different than a decade ago. Industrial demand, from solar panels to electric vehicles to semiconductor applications, has grown by double-digit percentages annually in recent years, even as mine supply struggles to keep pace. At the same time, safe haven demand driven by inflation, currency uncertainty, and elevated fiscal deficits has pushed gold prices into record territory, indirectly boosting silver's appeal as a high-volatility counterpart. Some market watchers even argue that silver could outperform gold in percentage terms if inflation expectations rise beyond current forecasts. Yet beneath the optimism lies a warning. While historical ratios and models can point to staggering upside, even targets above $200 per ounce suggested by independent analysts, markets rarely move in straight lines. Rapid swings of 15 to 25% up or down remain common in silver trading, and institutional positioning, futures market structure, and macroeconomic shifts can cause sudden reversals. That's why even BofA's own outlook couples its bullish targets with caution about possible corrections, urging investors to treat these figures as potential scenarios, not guaranteed outcomes. In this climate, silver has become one of the most talked about assets for 2026, not because its price today completely validates these lofty numbers, but because the combination of historical precedent, supply or demand imbalance, and shifting macro forces have created a narrative where anything becomes possible. Whether silver ultimately settles closer to $65, $135, or even $309 remains an open question, but the very fact that such projections are now part of mainstream institutional research highlights how dramatically investor expectations are evolving in a world still grappling with inflation, policy risk and economic uncertainty. After Buffett's 2026 outlook created headlines with predictions of silver potentially hitting between $135 and $309 per ounce. The next chapter in this story isn't just about sky-high targets. It's about why these numbers even enter the conversation and what real markets are signaling as the year progresses. Bank of America's metals research team emphasizes that the historic gold-to-silver ratio, about 59-1 today, could revert toward lows seen in rare past cycles, such as 32-1 in 2011 or even 14-1 in 1980. Those extremes are the basis for their most optimistic scenarios, explaining where silver prices could mathematically end up if conditions align, but not necessarily where they will in the short term. Meanwhile, other major institutions are tempering that optimism with more moderate forecasts rooted in current supply and demand realities. For example, HSBC recently raised its 2026 average silver price forecast to about $68.25 per ounce, up from a previous forecast of $44.50, citing persistent physical market tightness and strong investor interest. In this view, silver's trading range might fluctuate roughly between $58 and $88 over the year, with volatility expected as supply conditions evolve. This suggests that while forecasts like $135 or higher make dramatic headlines, the near-term path could be much more incremental if industrial demand, ETF flows, and geopolitical factors remain the primary drivers. What adds complexity is the broader macro picture. In 2025, silver recorded some of its strongest performance in years, with prices up more than 140% as industrial demand, ETF accumulation, and safe haven buying all surged. At the same time, some analysts warn that index rebalancing, such as adjustments to major commodity benchmarks, might temporarily create selling pressure equivalent to billions of dollars worth of contracts, potentially causing rapid pullbacks even in a bullish environment. This push-pull between strong fundamentals and technical pressures highlights why the silver outlook is far from linear. Digging deeper into fundamentals, Buffett's own research finds that silver has been in a structural deficit for several years, meaning physical consumption often outpaced production, and that shortfall is expected to continue into 2026. Analysts estimate global consumption of silver will remain slightly above mining output, reinforcing a narrative of long-term scarcity and therefore bullish structural support. Yet this supply constraint doesn't automatically translate to straight-line price increases. Markets can remain range-bound or swing wildly depending on investor positioning, interest rate expectations, and liquidity conditions. In contrast to the ultra-bullish peaks projected in extreme scenarios, other respected forecasts paint a more cautious intermediate future. Some forecasts have silver trading relatively flat near current levels in the short term, with technical models suggesting only modest single-digit percentage moves month to month. These models point out that short-term markets are often led by liquidity and macro news more than by long-term deficits, especially when futures markets and ETF flows dominate price discovery. This diversity of forecasts reflects a truth that many investors learn the hard way. Potential upside is not the same as guaranteed upside. By mid-2026, the real lesson may not be whether silver hits $135 or $309, but whether investors understand why such wide ranges exist in the first place. Are tight physical markets and historical ratios enough to justify massive rallies? Or will short-term technical pressures, index rebalancing, and macro volatility keep prices contained within more modest ranges? The answer to that will define not just this year's silver price, but how retail and institutional traders alike recalibrate their expectations for precious metals in the years to come. As silver's dramatic surge in 2025 and 2026 begins to settle into longer-term patterns, analysts and market researchers are now debating how the next phase, 2027 through 2030, might unfold. Rather than a single straight trajectory, forecasts suggest multiple possible paths for silver's price, each driven by how fundamental demand and supply dynamics evolve. In a base case scenario, where demand continues its gradual rise but price volatility remains, silver is projected to average around $47 to $55 per ounce in 2027, with the possibility of reaching $55 to $63 by year-end 2027. This scenario assumes industrial demand, led by solar, electrification, and electronics, keeps growing at a steady pace without dramatic supply shocks or policy disruptions. Looking further toward 2028 and beyond, structural demand trends could push average prices even higher if global adoption of renewable technologies accelerates. Many long-term forecasts see silver drifting upward year by year, with average prices approaching $54 to $64 per ounce in 2028 and a range of roughly $62 to $70 by 2029. By 2030, several commodity pricing models project silver could settle in a $71 to $90 per ounce range, driven by persistent supply deficits, expanded industrial utilization, and continued investment flows. Some models even anticipate prices touching the high $90s if global economic conditions, including weaker real yields and sustained fiscal stimulus, remain supportive of non-yielding assets like silver. These longer-term projections are rooted in the fact that industrial consumption is expected to account for an increasing share of silver demand as clean energy technologies proliferate. As of mid-2025, more than half of global silver demand was already industrial, especially in photovoltaic, solar panels, electric vehicles, and advanced electronics, and forecasts suggest that by 2030 solar demand alone could consume close to 30% of all annual silver supply. This structural pressure highlights why deficits, where demand exceeds mine output, may persist throughout the decade unless new production capacity emerges. But even the most optimistic forecasts acknowledge that silver's future is not guaranteed to be a smooth upward climb. Analysts caution that short-term volatility can still lead to significant drawdowns of 15 to 30% or more, particularly if global economic growth slows sharply or if ETF investment flows reverse. Additionally, some intermediate forecasts argue that silver markets remain heavily tied to gold's performance and to macroeconomic policy decisions such as central bank interest rate shifts. If real yields rise unexpectedly or if the US dollar strengthens markedly, silver's appeal as a hedge could diminish temporarily, slowing price growth. The decade-end outlook may also hinge on how emerging technologies influence demand. If developments in AI hardware, data centers, and next-generation energy storage systems increase silver's industrial footprint, the metal could experience demand shocks beyond current expectations, potentially narrowing the gap between base and bullish forecasts. But if supply keeps pace through increased recycling or new mine discoveries, despite silver being mostly a byproduct of other metal mining, then prices may rise more moderately. In sum, silver's trajectory from 2027 to 2030 is shaped by a combination of structural industrial demand growth, persistent supply deficits, macroeconomic forces, and investment sentiment. Whether it moves consistently toward $90 plus territory or fluctuates within a broader $40 to $70 range, one thing remains clear. Silver is no longer a niche asset, but a central player in both the energy transition and financial markets long term.